What if I told you that the old advice your parents gave you about investing might actually hurt your chances of building wealth? And what if I told you that there's a smarter way to start investing that most people have no idea about? Well, today I'm going to show you exactly that. By the end of this video, you'll know the step-by-step process to start investing your money in the smartest way possible for 2026. This isn't some get-rich-quick scheme or complicated strategy that only finance experts can understand. This is a practical, proven approach that anyone can follow, even if you've never invested a single dollar before. So if you're ready to finally take control of your financial future and start building real wealth, stick around because this video might change everything for you. Let me start with a story that might sound familiar. Last year, I met Sarah, a 28-year-old teacher who had been putting off investing for years. She had about $5,000 sitting in her savings account, earning basically nothing. Every time she thought about investing, she felt overwhelmed by all the options and advice online. Should she buy individual stocks? Should she use a robo-advisor? Should she invest in crypto? The more she researched, the more confused she became. Sound familiar? Here's the thing. Sarah's confusion is exactly why most people never start investing. They get stuck in analysis paralysis instead of taking action. But here's what Sarah did that changed everything, and it's the same strategy I'm going to teach you today. Step 1 is to understand your financial foundation. Before you invest a single dollar, you need to make sure your financial house is in order. This means having an emergency fund that covers 3 to 6 months of your expenses. I know this sounds boring, but here's why it matters for your investing success. When you don't have an emergency fund, you're more likely to panic and sell your investments when the market goes down. You might need that money for an unexpected car repair or medical bill. But when you have that safety net in place, you can invest with confidence knowing you won't need to touch that money for years. Sarah had her emergency fund ready, which is why she could move to step 2. Step 2 is choosing the right investment account. This is where a lot of people get confused because there are so many options. But I'm going to make this simple for you. If your employer offers a 401k with matching, that's your first priority. This is free money, and you should contribute at least enough to get the full match. If you don't have a 401k or you're already getting the full match, your next step is opening a Roth IRA. Here's why a Roth IRA is perfect for most people starting out. You contribute money that you've already paid taxes on, and then it grows tax-free forever. When you retire, you don't pay any taxes on the withdrawals. Plus, you can withdraw your contributions at any time without penalties, which gives you flexibility. The contribution limit for 2026 is $7,000, which works out to about $583 per month. That's totally doable for most people, even if you start with less and work your way up. Now let's talk about step 3, which is choosing your investments. This is where things get really interesting because the investment landscape has changed dramatically. 10 years ago, financial advisors would charge you high fees to pick expensive mutual funds. Today, you can build a diversified portfolio for almost nothing. Here's the smartest approach for 2026. Use low-cost index funds as your foundation. An index fund is basically a basket that holds hundreds or thousands of different stocks. Instead of trying to pick individual winners, you own a tiny piece of the entire market. For most people starting out, I recommend a 3-fund portfolio. This means you split your money between 3 types of index funds. About 70% goes into a total stock market index fund, which gives you ownership in thousands of US companies. About 20% goes into an international stock index fund, so you're not just betting on the US economy. And about 10% goes into a bond index fund, which provides stability when stocks are volatile. This simple approach has beaten most professional money managers over the long term. And the fees are usually less than 0.1% per year, which means more money stays in your pocket. Sarah started with exactly this approach, investing $500 per month split across these 3 funds. But here's step 4, which might be the most important: automating your investments. The biggest mistake I see people make is trying to time the market. They wait for the perfect moment to invest, or they stop investing when they hear scary news. But here's what the data shows: time in the market beats timing the market. The best strategy is to invest the same amount every month, no matter what's happening in the news. This is called dollar cost averaging, and it works because you automatically buy more shares when prices are low and fewer shares when prices are high. Set up an automatic transfer from your checking account to your investment account every month. Treat it like any other bill that has to be paid. Most people spend more on coffee than they invest for their future, which is backwards. Your future self is more important than your current caffeine habit. Now let's talk about step 5, understanding your timeline and risk tolerance. If you're investing for retirement and you're under 40, you can be more aggressive with stocks because you have decades for the market to recover from any downturns. But if you're saving for a house down payment in 2 years, you shouldn't be investing in stocks at all. That money should be in a high-yield savings account or short-term CDs. The key is matching your investment strategy to your timeline. Money you need within 5 years should be conservative. Money you won't need for 10 or 20 years can be more aggressive. Sarah was investing for retirement, so she could handle the ups and downs of the stock market. Step 6 is staying educated but avoiding information overload. You should understand the basics of what you're investing in, but you don't need to become a finance expert. Read one good book about investing, like The Simple Path to Wealth or The Bogglehead's Guide to Investing. Follow a few reliable sources for financial news, but don't check your investments every day. The more you check, the more likely you are to make emotional decisions that hurt your returns. Sarah checked her investments once a month, just to make sure her automatic contributions were working. That's it. She didn't stress about daily market movements or try to predict what would happen next. Here's step 7, increasing your contributions over time. Start with whatever you can afford, even if it's just $50 per month. The important thing is building the habit. Every time you get a raise, increase your investment contributions before you increase your spending. If you get a 3% raise, put at least half of that toward your investments. This way, your investing grows with your income, and you barely notice the difference in your take-home pay. Sarah started with $300 per month and now invests over $800 per month because she followed this approach. Finally, step 8, avoiding common mistakes. Don't try to pick individual stocks unless you're doing it for fun with money you can afford to lose. Don't chase last year's hot investment trend. Don't panic and sell when the market goes down. Don't pay high fees for actively managed funds. And don't let perfect be the enemy of good. You don't need the perfect investment strategy. You just need a good strategy that you'll actually stick with for decades. The magic of investing isn't in finding secret strategies or beating the market. The magic is in starting early, staying consistent, and letting compound interest work for you over time. If you invest $500 per month earning 7% annually, you'll have over $1.3 million after 30 years. That's the power of consistency and time. So there you have it, the smartest way to start investing your money in 2026. Remember Sarah from the beginning of this video? She followed these exact steps, and in just 2 years, she's built a solid investment foundation and feels confident about her financial future. You can do the same thing. Start with your emergency fund, open the right accounts, choose low-cost index funds, automate your contributions, and stay consistent. It's that simple, but simple doesn't mean easy. The hardest part is actually getting started. If this video helped you understand how to start investing, hit the like button so I know to make more content like this. And if you have any questions about these steps, leave them in the comments below. I read every comment and I'll do my best to help you out. Your future self will thank you for taking action today instead of waiting for tomorrow. The best time to start investing was 10 years ago, but the second best time is right now. Thanks for watching, and I'll see you in the next video.